I want to tell you a little bit about what's going to happen today. So first, I'm going to talk a little bit about the history of LIBOR going away. And I have a sense that this is not a completely unsophisticated audience. I have a sense that how many here have actually heard that LIBOR is going away, and that's why you're here? I have a sense that this is not the first time most of the folks in this audience have thought about this topic. So what our real goal is really not this first panel, not this first topic. So the first thing that we're going to do today is, try and very briefly run through the history and some of the background of the problems and issues. And then we want to get into the real meat of today. And the real meat today will be our second panel and our third panel. Our second panel is going to be all about practical advice on what to do now. And we have a number of folks from a number of different areas. I'll be on that panel talking about structured finance transactions. We have Curtis Doty, who's a partner in our derivatives group, who's going to be talking about what's going on in the derivatives world. Barbara Goodstein, who does both lending and some structured finance, will be talking about a lot of the things that are happening in lending and again, practical advice. John Janisic, who's in our municipal finance group. Anna Pinedo, who's one of our capital markets partners. And so the idea is that in all of these different areas, some of which overlap, some of which have unique problems, what we really want to do is talk about practical advice about what to do now. And then our final panel of the day is going to be about the things that have, what the legacy deals look like, the existing deals that are going to have problems, and we have some really good litigators and a transactional lawyer on that panel. Chris Haupt and Matt Ingber are the litigation partners, and Sagi Tamir, who's a transactional partner, are going to talk about the disputes that are likely to happen. What are the things that are likely to go wrong? Is this, in fact, going to be a train wreck when we get to the end of 2021? And what are some of the strategies to help avoid some of that litigation and some of those disputes? Now, we've got a big room, but it's not that big of a room. I think we'd like this to be as interactive as we can make it. I really want to encourage folks to just sort of raise your hands if you have questions or you want to, we're touching on something and you want to get into that more. Please feel free to do that. And let's go ahead and there will be a break at about 3:50, and there will be cocktails after this is all over, and I really hope folks, and some decent hors d'oeuvres, and I really hope folks will stay for that. All right, so the history and background. Now, awkwardly, I don't know if I'm going to disconnect everything if I move this. I don't know if I'm going to disconnect everything if I move this up a little bit so I can actually change the slides. I don't see, I do have a clicker, even better. So how many people here were, first of all, how many people here are not lawyers? Oh, excellent, about half the room. Hi, are you want to speak too?
No, that's fine.
Thanks. How many people here were either had something to do with either documenting or participating in transactions that might have had a LIBOR provision somewhere before 1990? Okay, and we never asked people their age, and so that might have been a faux pas of mine, and I apologize. All right, so when I started practicing, I am older. I never think of myself as being old until I start thinking about how long ago I started practicing. But when I started practicing in the mid-1980s, All right, so I was a young associate, and I admit I didn't really understand all of the LIBOR provisions that were in the documents. But what I now today understand is that banks were actually, when they were providing, when LIBOR was being used, there were actually banks or trustees going out and getting LIBOR funds. They were actually going out into the interbank market and getting LIBOR funds, and that's why they needed 2 business days in advance to know that the borrower wanted LIBOR and wanted LIBOR pricing, and that's why we had fallback provisions. And when you look at the fallback provisions that are in documents today, and you want to try and blackline them against the fallback provisions from the mid-1980s, it's shocking, but they blackline really, really well. And nobody ever thought that banks were going to stop borrowing in US dollars from other banks. There might be some disruption that might last a day or two, but nobody ever thought that we'd have a situation where LIBOR would simply disappear, because the whole concept of banks not borrowing from banks could never disappear. Banks are always going to borrow from other banks. And so the fallback provisions that are in deal documents and have been in deal documents, literally for, the last 2 generations, were all designed to deal with short-term disruptions and never were designed to deal with LIBOR going away. And that's what we're facing with. So again, just a little bit of the history. Soon after I started practicing, maybe the British Bankers Association was compiling LIBOR, even at that time. But certainly shortly after I started practicing, we started seeing BBA LIBOR as a defined term in documents. And LIBOR was managed by the British Bankers Association, and each business day they would go out and calculate rates based on submissions by lenders. And that all worked fine until we got to the financial crisis. And then somewhere around 2012, we started seeing all of these allegations of misconduct in the LIBOR market. And then something had to change. So in 2013, the Financial Conduct Authority decided to select ICE to be the LIBOR administrator. Now it's not BBA, it's going to be ICE, a third party. And the goal was to bring more transparency and oversight to the calculation of LIBOR. Hold on, I do have a clicker. So what's happened? Today, nobody does match funding, or at least I'm not aware of anybody who does match funding of LIBOR anymore. And as that decline of match funding has happened, there are fewer quotes. There's less volume of actual LIBOR trades to base pricing on. So weirdly, the setting of LIBOR has become almost, not identical, but almost like the same setting of pricing for thinly traded securities. You have market makers who have a bid and an ask spread, and that bid and ask spread sometimes widens more than we'd like it to. And there's not the same liquidity that we would like for a true benchmark rate. All of the panel banks that have agreed with the UK Financial Conduct Authority that they're going to continue to supply LIBOR quotes until the end of 2021. But remember, these are quotes that they're providing. They're not necessarily based on actual trades. We don't know whether those quotes will still continue to happen after 2021. Some of the other problems, if you're quoting, there's the litigation. Lots of banks are gun shy about making those quotes or continuing to do that after 2021, just based on the litigation that's already happened. And LIBOR spreads have widened compared to other benchmarks as a result of that thin trading. So why does LIBOR matter? LIBOR stands for London Interbank Offered Rate. It's the interest rate at which banks offer, at least theoretically, offer to lend funds to one another in the international interbank market. And LIBOR was designed to reflect how much it costs for banks to borrow from one another in specified currencies, and in particular in dollars, for specified periods of time. And LIBOR is used, as we know, in, got a question back there. Banks have all sorts of alternatives to fund. And, they're using their own short-term borrowings. Again, just because you're setting a rate of LIBOR for a loan in the United States doesn't necessarily mean that you're going offshore to get the money. You can get the money from just your ordinary borrowings. You have deposits, all of the different sources of funds that you have. LIBOR today is merely a price for an interest rate. It literally is just that. But I'm not aware, and again, we have lots of bankers in the audience. I'm a mere lawyer. We have lots of bankers in the audience. I am not aware of anybody, any bank that's lending today that's actually thinking about, what is their pricing going to be by going offshore and actually using their true cost of funds for that loan. They're not match funding that loan. Yes. So just to repeat the question for those who didn't hear, it was really more of a statement than a question, but just to repeat that statement. The gentleman in the back said, LIBOR was intended in part to, help get away from prime, which was a rate set by the banks, and become a more market rate. And you're exactly right. That was certainly what the intention is. And today, LIBOR is much less of a market rate than it was when banks started using LIBOR. When banks started using LIBOR, like I said, when I started practicing law, LIBOR truly was a market rate, and it represented actual pricing in actual transactions. Okay. But thank you for your question. So, and I would encourage, the more that this is a conversation today, the more helpful it's going to be to everybody. And, frankly, that's probably more interesting than me just lecturing at you than to actually talk about the things that everybody cares about. So the combined exposure to LIBOR in the market today is almost $200 trillion, and 190 trillion of that is the derivatives market. So that's a lot of money. The Fed and the Federal Reserve Bank of New York convened a joint committee, the Alternative Reference Rates Committee, otherwise known as ARC, to identify a rate. That committee wanted to have a risk-free rate that would be a theoretical rate of return on an investment with no risk of financial loss. And they identified SOFR, the Secured Overnight Financial Rate, and that's the cost of overnight loans that use U.S. government obligations as collateral. And this type is probably smaller than it should be, but.
Do you circulate the materials?
We will. I don't know if Jessica is here, but we will make sure these get posted on our website. So yeah, they will be circulated. What are some of the issues with SOFR versus LIBOR? And we're going to talk about some of these issues a lot more in some of the other panels. But there are all sorts of reasons why SOFR doesn't really match up with LIBOR in the way that we'd like it to. So first of all, SOFR is a risk-free rate. LIBOR is not a risk-free rate. So one would expect a risk-free rate to be lower than rate that's not a risk-free rate. So if we make a change from LIBOR to SOFR, we would expect that there probably has to be some kind of a spread adjustment. LIBOR as a not risk-free rate probably is going to widen, right? Those LIBOR spreads are going to widen in periods of stress. SOFR probably, maybe it'll widen, but it'll probably widen less. SOFR is likely to be less volatile, but more volatile at quarter ends. Now, when people say it's going to be more volatile at quarter ends, I confess I don't really know why they say that, but that's what folks have said. SOFR is an overnight rate, and it changes every day. LIBOR typically gets quoted as 1 month LIBOR or 3 month LIBOR, and so SOFR is not a term rate. SOFR is also a backward-looking rate. You know, when you get a quote of SOFR, it's what SOFR was today, not what SOFR is gonna be tomorrow. So there are all sorts of complications. If you're trying to use SOFR as a replacement, somewhere along the line, we're kind of trusting market forces to develop a 1 month SOFR or a 3 month SOFR, and to be able to make that turn into a term rate. And ARC is clearly trying to do that. That's one of the things that's one of their goals. And unfortunately, before they feel they can do that, they feel they need some experience, particularly with derivatives trading. And the date when ARC is going to come out with a term 1 month SOFR, a term 3 month SOFR, may not be until we actually hit the end of 2021. They were originally planning second quarter of 2021, but they recently backed away from that and now have said the end of 2021. So when LIBOR goes away, we may not actually have a term rate that's actually in existence unless market forces can somehow create that. And I think that will happen, but we don't have certainty that it'll happen and that it'll happen in sort of a correct way. You know, some other complications, when you're trying to get a daily rate to turn into a 1 month rate, how do you do that? Do you take averages? Do you do compounding? Again, somehow we're going to have market practices that develop and come up with the right answers to some of these questions. Spread adjustments. You know, spread adjustments are another kind of important issue. You know, when people think about how will the spread adjust, do we just simply look at the difference between LIBOR and SOFR on the day we make a change? Or now that we actually have SOFR and there are quotes of SOFR, do we look over a longer period of time? Because the difference between LIBOR and SOFR today is probably going to be slightly different from the difference between LIBOR and SOFR tomorrow and a month from now and a year from now. So do we look at a longer term to determine the spread adjustment, or do we just look at that particular day? And how do we minimize the value transfers that happen just because we're changing from LIBOR to SOFR and we make that adjustment? And I think these are all really hard things, and we're going to talk about some of those a little bit more in a little bit more depth later on. Another really interesting thing is when we make changes from LIBOR to SOFR, all sorts of weird things happen. So for example, if we amend a bond and we change from LIBOR to SOFR, is that the kind of a change that now we have a gain recognition event for tax purposes? Do we need some help from the IRS in order to make sure that that doesn't happen? The short answer is yes, we do. And you know, all of the tax folks and all of our trade associations are all aware of that. But that process is just starting now to request help from the IRS, some kind of a ruling that won't be by itself a gain recognition event. Swaps, and you know, Curtis is going to talk a lot more about everything that's going on in the derivatives world in terms of replacing LIBOR. But one important thing is, if we have a swap and we change from LIBOR to SOFR, is that a new event that if we had a swap that didn't need to be cleared, now it's going to have to be cleared because we've done this amendment, it's effectively a new swap. I think those sorts of questions are we're going to need some help from the CFTC. Here's another one. How about accounting? Let's assume that you've got hedge accounting right now. And so you've got an asset that you're hedging, and now you change that asset. Are you potentially going to lose your hedge accounting because it's no longer as good of a hedge? Again, probably not, but I think it's certainly a question that folks have to worry about when they think about the switch from LIBOR to SOFR. In response to a lot of these concerns, ARC expanded beyond derivatives to include sort of all of the participants in the cash markets, in the lending markets, LSTA, SFIG in the securitization market, SIFMA is now a participant, and so they're getting more viewpoints about what should, more viewpoints from more parts of the market. And so they're also, again, one of the ARC goals that they announced in November was to develop a SOFR-based rate that would be forward-looking and would be a term rate. Again, that rate would still be risk-free, so it would still be lower than LIBOR. It would still need a spread adjustment. And again, I think I mentioned they now aren't promising to have that before the end of 2021, although they might have some trial balloon demonstrator rate. So ICE has also reacted and made some changes to LIBOR. And ICE, in making its quotes, is using a waterfall methodology. So they're effectively looking at the sources of LIBOR quotes in order to determine what they're going to put on the page. And so what are they putting on the page? What numbers are they releasing? So first, they're going to look to level 1 sources, real trades. Second, they're going to look to transaction-derived quotes. And I don't really know what that means, but somehow using historical data. I'm not sure exactly how that level 2 is going to work. And then finally, expert judgment. And that's really what the banks are providing when they don't have trades. But it's not like ICE is saying, this LIBOR quote that we have for 1 month LIBOR today that we're releasing to the market. It's not like they're saying that's a level 1 quote or a level 3 quote. They're just giving their quote. So there's not as much transparency, I think, as folks had hoped for in the calculation of LIBOR. And that process is intended to be complete by the end of the first quarter of 2019. Again, not clear whether there will be more transparency by then. Some other recent developments. The Federal Reserve Bank of New York began publishing SOFR, and it's been published every day since April of this year. But again, just like LIBOR, the calculation of SOFR is kind of a black box. Nobody really can see what it is other than just that quote. Some other interesting developments, Fannie Mae and MetLife have actually done SOFR transactions. So now we actually have experience with real live bonds that have real live SOFR quotes, and people can actually look at that. And those deals are trading in the market every day. SFIG in the securitization market is working on a green paper that's been going on for quite some time, but something that highlights many of the important issues in the securitization market and suggests some possible language for structured finance deals. So what's going to happen to LIBOR after 2021? And I think we don't really know. I have a crystal ball, but I need a new one because it doesn't predict the future as well as I would like it to predict the future. But there's certainly market talk about keeping LIBOR. And ICE certainly has said that they intend to continue to have something that will be a LIBOR quote that they will be putting out. One of the really interesting things in the last couple of months, how many people in this room work for a company that's gotten a letter from ICE asking you to sign a license agreement and pay them royalties, pay them licensing fees for your use of LIBOR? Yes, I see some hands. So a number of our clients wound up getting that for a date in, I think it was October 19th was your deadline to enter into a licensing agreement. And then they were going to tell all of the folks who they have licensed, like Bloomberg, to turn off your LIBOR access unless you entered into a licensing agreement. And what they no doubt did was hired somebody, or they did it themselves. They actually looked, how hard is it to just search on the internet anybody who has a bond that's pricing off of LIBOR and then send them a letter saying, you owe us a licensing fee, sign a licensing agreement. And the licensing fees, as I understand, were not that significant. They ranged between $8,000 and $15,000. But the idea that ICE is going out and actually trying to enforce their rights to get a fee for the use of LIBOR gives you some idea about what ICE is thinking in terms of, what their plans are. They plan on, my crystal ball isn't perfect, but I predict that ICE will be trying to get licensing fees after the year 2021 for publishing LIBOR. Now, there could be LIBOR quotes by somebody else, but who's going to be that somebody else? I think it's going to be ICE. And if they did, they'd have to comply with some of the new EU benchmark regulations, which may not be easy to do. But as we go forward, certainly for banks who are doing lending, it's very clear that the Fed is adamantly against any use of a LIBOR type of rate. The Fed doesn't like LIBOR. I mean, it's that simple. So, if the bank regulators are going to frown on using LIBOR, at least, U.S. banks are probably not going to be using LIBOR as much. But having a quote of LIBOR is probably still going to be very helpful for legacy deals. And having that quote still be available may, in fact, be the best solution for some of the legacy deals. So, how about those legacy deals? Now, again, our third panel is going to talk in a lot of detail about legacy deals, about the disputes, about some of the issues, and I definitely don't want to take too much of the wind out of their sails. Again, a reminder that most of the fallback provisions in our existing deals were originally designed to deal with a short-term disruption and not LIBOR permanently going away. Let me just quickly look at my watch and make sure that I know where we are on time. So what are the kinds of fallback provisions we have in our transaction documents right now? Well, in lots of deals, we look at a screen, and if that screen doesn't get published or LIBOR is not available on the screen, what do? We typically have somebody, whether it's a trustee or the lender, go get quotes. And if the quotes can't be obtained for some reason, then lots of loan documents turn you over to prime, some alternate base rate that typically winds up being the higher of some things, and prime is usually the one that ends up being that benchmark. Sometimes loans use a lender's cost of funds, but I mean, that's certainly not a long-term solution, and I think nobody wants that. I don't think any bank really wants to get into that or get into the disputes about, what's their cost of funds. And securities transactions, and certainly securitization bonds, often use, if nothing else works, then you have the last LIBOR quote, which might be fine when you have a short-term disruption of LIBOR, but if LIBOR has in fact gone away, then what it means is you've now turned this floating rate deal into a fixed rate deal, and that's a terrible consequence. And that is the one thing that I think might be motivating some investors now to start speaking up and say they want something different. Again, we'll talk about that more. Some issues in legacy transactions are, when has LIBOR become unavailable? What does that mean? What if there is a quote on a screen? And then what happens next? And if there is a quote on the screen, I think that could be a solution. How difficult will it be for trustees to get quotes? Well, I think if you've tried to do a new deal lately and you have some obligation for the trustees to get quotes? By the way, how many, just a quick show of hands, how many people here work for trustees or represent trustees? Not as many folks. All right, well, typically, well, you guys, right, agree with me or not? Now you're trying to avoid having to go out and get quotes. So now we sometimes have made changes for the issuer or sponsor to go get the quotes, or we've eliminated that step entirely, or we've provided for additional discretion. But clearly the trustees have absolutely no interest anymore in getting quotes. They don't know how they're going to do it. They don't know what it means to go do that when it's hard to find anybody, when it may be hard to find somebody who's actually, quoting LIBOR. Can we amend our LIBOR definitions in some of those legacy deals? Some deals, at least in the securitization market, which I see quite a bit, you can do amendments as long as the rating agency isn't going to downgrade your deal. And sometimes it's just providing a notice to the rating agency, and the rating agency doesn't downgrade, 10 days advance notice, and the rating agency doesn't tell you they're going to downgrade. Well, if that's the case, you might actually be able to do amendments. But sadly, that's not the way most of the deals work. Lots of deals have a standard that requires no adverse effect on investors or no material adverse effect, and often requires a legal opinion that says that. And that's pretty tough legal opinion when you're talking about changing a benchmark. You have no idea whether the benchmark, whether rates are going to go up, whether rates are going to go down, whether, SOFR spreads are going to go up or down compared to what the LIBOR rate would have been. How could a lawyer give a legal opinion? I'm not saying that law firms won't find a way to help clients, but at this point, it does seem fairly challenging for a law firm to give a legal opinion that investors wouldn't be adversely affected by a change to a different benchmark. And there are lots of deals that allow you to amend, in all sorts of different ways, depending on what they are. But even the deals that can be amended with a majority of the investors typically have a list of what are called sacred rights. And those sacred rights can't be amended, those things, without getting the consent of every affected investor. And that means unanimity, and changing the interest rate typically is one of those things. So how about investors? Do investors have any incentive to push for changes? And we think they do, certainly in those deals where they can end up with a fixed rate deal in a rising rate environment. We think that investors might have that incentive. But at this point, how many investors are in the room? One investor. See what I mean? 2 investors. All right. But I think that says a lot about kind of where the investors have been. The investors really haven't been as active in all of these discussions. And I think it's very important to investors that they not get hurt in the process, but they haven't been the ones who have been proactive. There aren't a lot of investor conferences where they're all getting together and saying, this is what we want. Instead, they have been invited to seminars like this, and they've made their voice clear that they don't want to get hurt, but they haven't necessarily said this is the way we want it to look on a go-forward basis. So that's really important as we go forward, is making sure that investors are going to be okay, and it'd be nice to have a little bit more proactivity by investors. That is not a complaint. It's just simply recognizing that the entire market would move in a week if investors said, this is what we want. So then I ask the question, because we have these legacy deals and because we have so many transactions that are very difficult to amend, is this going to be a train wreck? Let me just leave that as a question, and our third panel will try and answer that today. Who's going to get hurt in legacy deals? I think it's safe to say that no matter what happens, probably the trustees in all of those deals are going to get sued, because investors are either going to like what happens now. Somebody's not going to like what happens, and the trustees tend to be in the middle And I think that they have the greatest target on their backs. I think a lot of deal sponsors, the folks who are the issuers in securities transactions are going to try and amend when they can, but it may be more difficult to do those amendments until there's actually a problem. So how about new deals? And sorry, I don't know why my watch is vibrating. So how about new deals? Again, what are the basic issues? The basic issues are what's the trigger that says we need to replace the benchmark with a new benchmark? What's the benchmark that we're going to be selecting? Yes, it's probably going to be SOFR, but what variation of SOFR? Compounding, anything else? What are the spread adjustments going to be? How do we assure investors don't get harmed? And finally, who gets to make those decisions? Is it consensus? Do investors get to vote on it? Or does it happen without their consent? Some really basic questions about spread adjustments. Is it a static spread adjustment, right? It happens on one day, and we try to make the spread adjustment is whatever makes today's interest rate equal, today's interest rate at LIBOR equal today's interest rate with a SOFR benchmark, and then that's the spread adjustment forever? Or is it more dynamic? Are we going to use averages, or are we going to use something else? How far back are we going to look at the differences between SOFR and LIBOR? Are we potentially going to have different adjustments for different parties? I think that would, in a syndicated loan, I think that would be almost insane and certainly very difficult to make happen. In loan transactions, are lenders going to set the rate, or are borrowers going to somehow have the right to consent or approve? In securities transactions, will investors get to approve? That's something that a lot of investors, when they've wanted to protect themselves, they've come to meetings and said, yeah, we'd like an approval right, or at least the ability to object in some way. At the end of the day, I don't think that's really going to happen. I don't think that's very practical. It's just too complicated to do a consent solicitation in order to get investor consent, or to somehow figure out what you're going to do if one investor happens to raise their hand, but everybody else doesn't, and says, I don't really like the way you did that. All right, so what's really happening in the real world right now? Again, we're going to be talking about this at much greater length during the next couple of panels. But in my mind, bargaining power is the single most important thing that's going to determine in any situation what's going to happen. And some folks in this room have worked with me quite a bit, others not as much, and others, have never seen me before this moment. But if you work with me a lot, you hear me say the words Category 1, Category 2, and Category 3 companies. Okay, and Category 1s are the ones who have the most bargaining power. They tend to be the most financially healthy. They tend to be highly rated. Often they're publicly traded, and they tend to have lots of bargaining power. Category 3 companies, all the way on the other side, tend to be small, not as financially healthy. And they tend to commit fraud and go bankrupt a lot more often than the Category 1s. And so the Category 3s tend to have no bargaining power. They often have a hard time finding folks to do business with them, and when they do, those folks will try to protect themselves quite a bit. And then the Category 2s are kind of everybody in the middle. And by the way, that's not just a lesson about, this stuff. That's a life lesson. I mean, it's sort of funny, but, as a law firm, we tend to give discounts to the Category 1s. We tend to get retainers from the Category 3s. But the Category 1s have the most bargaining power. And so when you look at transactions that are going on in the market and you focus on bargaining power, I think that's a pretty good idea of how it's going to all work out. So in lending transactions, where you have a bank that's got lots of bargaining power and you've got a borrower that has no bargaining power, what's going to happen? The bank is going to have a LIBOR provision that's going to pretty much let it set the benchmark rate. There may be some standards that are attached to it. The borrower may decide to, try to negotiate that in some way, shape, or form. But by and large, I think we can all recognize that the lender is going to have its form provision, and it's in fact going to say these are our standards, this is our form. When you have securities transactions, and we'll talk about this again a little bit more in the next panel, but there are some certainly securities sponsors that have lots of bargaining power. They have a following, and investors tend to trust that those kinds of companies aren't going to do something harmful to investors. They've provided more discretion for themselves, and we're starting to see that more. But for the companies that have less of a following, have less of an ability to get investors to buy their deals, what are they tending to do? They're tending to do what they did on the last deal. Why? Because they don't know if they make a change whether investors are going to be unhappy, and they're going to suffer in pricing. So bargaining power is what I think is going to be the single most important thing that determines what folks do in every situation. So just a quick summary. So LIBOR is going away, and SOFR is likely, some variant of SOFR is likely to be what replaces it. There will be a forward term rate that can get used instead of 1 month and 3 month LIBOR. Exactly how that will be calculated and how it will look, and whether it develops on time, I think are big question marks. It's not clear exactly what the alternate, what the adjustments are going to be in each different market and how that's going to work. I think a lot of folks are betting on the derivatives market being the one that most likely gets it right. And it's probably premature, unless you've got a lot better crystal ball than mine, it's probably premature to actually say what the rate is going to be in your future deals and to amend to a particular benchmark and spread adjustment, because how do we know what really is going to be, what the market really likes and favors, and even what develops between now and, say, the end of 2021, early 2022. And over the next few months and over the next couple of years, we will be developing the language that folks are using in new deals to try and at least grapple with or give folks the discretion to grapple with all of these issues. And with that, thanks a lot. All right, so I'm going to ask our next panel and the panelists to come on up. Please feel free, honestly, even when we're talking, to get up and grab a cookie if you want to, get something to drink. We have all sorts of stuff in the back. So don't be bashful about that. So we've got a bunch of things. First of all, let me introduce everyone. Or actually, why don't I... It is pushed, and mine says green. Can you hear me now if I'm talking literally right into this thing? Okay, all right. Guys, that means we have to literally talk right into this thing. All right, well, that's what we'll do. All right, so feel free to get up whenever you want, go to the bathroom. Don't be Asheville. And please feel free to raise your hand, ask a question. We're intending to have a conversation up here, and the more you participate, the more of a conversation it is. So I think we're going to start with the types of LIBOR definitions that we've been seeing in the legacy transactions. And oh wait, I'm sorry, I was going to introduce everybody, and I'm going to let everyone introduce themselves. Anna, you want to start?
Sure. I'm Anna Pinedo. I'm a partner in the New York office in the Capital Markets Group.
Curtis Doty in the New York office in banking finance, and I do derivatives and very little else.
Barbara Goodstein, a partner in the finance group in the New York office, and I do mostly syndicated loans and structured finance transactions.
And you've already heard from me. I'm Stuart Litwin, and I'm a securitization lawyer.
I'm John Janisic from the Chicago office of Mayor Brown, and I'm practice in our government area, and for this purpose, municipal finance.
All right. So let's start with the types of LIBOR definitions that we see in our legacy deals, and what are the basic problems that we're seeing in legacy deals as we approach potentially having to replace LIBOR? Do you want to start us off? Or?
Sure. So in notes, floating rate notes or fixed to floating rate notes, the problem is that most of the provisions that exist in those notes, though there are many permutations, essentially would provide for a fixed rate note to essentially default into or to become, for a floating rate note to default into or to become a fixed rate note for life once LIBOR ceases to be published. There, in legacy deals, isn't really an opportunity for a calculation agent or another third party to have discretion to to identify a different rate. And so I think for most issuers most frequent issuers of debt in the public and private markets have already started for some period of time to implement alternative fallback measures in their notes. And I'm sure that we'll get to this in a little bit, but there are a number of problems, or at least intricacies in terms of dealing with the various alternative fallback provisions that frequent debt issuers have started to incorporate in their floating rate notes. And then, of course, there's the more interesting and more challenging problem, which I'll kick off, and our litigators will, I'm sure, talk about some more, and that's what's to be done with the legacy notes. So all of these notes that effectively will become fixed for life or fixed for their remaining term to maturity once LIBOR ceases to be published or ceases to be a benchmark rate. So that's the basic problem in the floating rate note market. And maybe I'll leave to Curtis and Barbara to talk a little bit about what the standard is in derivatives and in bank agreements before we come back to what to do with legacy debt.
Okay, maybe I'll just jump in here. So the problem with LIBOR definitions and syndicated loan agreements is, of course, that none of them really contemplate LIBOR going away permanently. So what you have, your typical LIBOR definition is going to say what happens when LIBOR is temporarily unavailable, which means you're going to default usually to a prime or Fed fund-based rate, as we all know, which is going to be fairly expensive for an issuer/borrower. And again, the concept behind it is, while LIBOR is temporarily available, it will come back. So there's nothing really addressing what to do where LIBOR is permanently unavailable. So that's a short answer to your question. I'll let Curtis step in.
Yeah, in derivatives, and I'm going to focus on the case where you've got a derivative that's hedging a loan or a securitization debt instrument. The standard fallbacks are published by ISDA in the 2006 interest rate definitions, and they provide if the specified screen source is not available, then there's a fallback to a dealer pool of reference banks at which banks in the London interbank market would lend to themselves for the stipulated tenor. And if the requisite number of poll responses aren't obtained there, then it defaults to a pool of banks in New York, and it ends there. And then in transactions where you've got an interest rate swap that's hedging a loan or a securitization note, there's going to be discussion between the issuer and the hedge provider to see how much alignment is obtainable between the two instruments. And typically the outcome there is you try to massage the definition in the debt instrument to be as close as possible to the ISDA definition, although there may sometimes be some basis, some risk between the source of the dealer pool, or you might have a dealer pool under ISDA and a determination by the admin agent based on a pool of banks under the debt instrument.
Anything about that?
Just with respect to the municipal industry, it is the tail on the large dog. There's only about 42 billion of that debt out there that's using the rate. So we've got alternate rates that are used, SIPMA, the Securities Industry and Financial Markets Association Index, Bond Buyer Index, and there's also needs to be a conversion on the LIBOR rate for the municipal industry because so much of that is tax exempt. So we are likely to be a market follower as to what the rest of the market is doing in this regard. There are some particular instances that were floating rates notes done in the mid-2000s, which were longer term and based only on LIBOR. So there is concern about what to do with that. Much of the corporate market is short of the 30-year term. So there is concern, but again, I think we'll be followers with respect to what to pick up on.
One of the things about although I'm a securitization lawyer, I do a lot of lending, securitization type lending. And, one of the things, some of our deals are bilaterals with just one bank, but lots of deals are, large syndicated loans, just like, many of the loans that you work on. You have some of the same amendment problems that you have with large syndicated loans that you have with, with securities transactions. You might not have as many holders as you could potentially have in a big publicly traded, securities offering, but you might, in a syndicated loan, still have a lot of lenders. And while you would have amendment provisions in a typical syndicated loan that would be the required lenders that would often be a majority, you would have something like a pricing change would also be one of those things that requires unanimous consent before you could make that change. Now, I think that the lenders in a syndicated loan probably have more aligned interests, perhaps, than sort of the issuer in a securities offering, the issuer and all of the investors. But I think you do have some of the same issues where you've got the potential that one lender thinks that the spread adjustment ought to be X, another lender thinks that it ought to be Y. You've got some lenders in the syndicate that have a closer and tighter relationship and maybe perhaps more fee income opportunities from that borrower than some of the others, and that may influence whether they're willing to go with a tighter spread adjustment or a wider spread adjustment. And you don't necessarily have as easy a time, even in the big syndicated loans, necessarily getting that approval from everybody, getting everybody on one page, I suppose.
Yeah, no, that's absolutely correct. The change in interest rate, I think, as you mentioned just now and earlier, is a sacred right. Based on current syndicated loan documents, you need to get everybody in. And so I don't know if you want to talk about where ARC is going in terms of syndicated loan agreements, or I don't want to get ahead of ourselves on this. So So ARC is pushing in the syndicated loan industry for what they call a hardwired approach. There are kind of two theoretical approaches out there now. What the Fed is calling, I shouldn't say ARC, the Fed is pushing for a hardwired approach. And then there's the amendment approach. And the amendment approach is, I think, what we're seeing almost universally in the syndicated loan industry because of everything that Stuart said earlier, which is we don't really know where SOFR, which I've heard referred to as so far away, is going. Banks are not comfortable with all that uncertainty because you've got a day overnight risk-free rate, translating that into LIBOR equivalent plus a margin down the road. There's just not enough out there now. So I'm seeing everybody heading down the amendment route. And the amendment route being, I think what probably a lot of you are seeing, which is you get the administrative agent together with the borrower and they propose a substitute rate. And that substitute rate has certain parameters. It has to really be consistent with the market practice. It has to take into account pricing for equivalent credits. I mean, there's a lot of soft language running around right now, but I'm kind of starting to see it gel more and more. And then whatever that amendment is that the borrower and the admin agent come up with, they're going to submit that out to the required lenders. And then there's going to be usually now a 5 business day period. I was seeing 10 for a while. It looks like it's shrinking a little. And it's they're going to submit it to all the lenders. If they don't get an objection from the required lenders, then that's going to be the new substitute rate. So that would address your outliers who don't want to sign on for something and, avoid the disruption that everybody wants to avoid when we suddenly find ourselves based on one of these trigger events that we're also going to talk about without a pricing mechanism. Now, again, a lot easier to some extent than in a public deal. Maybe not quite as, or maybe your bilateral swap
those
deals
are easy.
Right, very easy. So we're kind of in the middle here, how to manage a small, manageable group. I mean, Anna, how do you see this kind of playing out in the note market?
So in the note market, no one has come forward, Barbara, with any proposed amendments to their floating rate notes. I think some of the challenges are that at this point, Barbara, as you said, no one's quite yet comfortable with SOFR. Of course, there have been a handful of SOFR issuances, but I think there's still some uncertainty. So at this point, what we're suggesting to clients with significant outstanding maturities that are tied to LIBOR or LIBOR-based is that they go through and assess and understand where each of those notes falls. So, for example, I mentioned that in your typical floating rate note provision, the LIBOR calculation would default to the note becoming fixed rate for the remaining term to maturity. However, even a year ago, 2 years ago, when we already had visibility regarding LIBOR, some frequent issuers started to make modest changes to their interest rate provisions, to their reset provisions, and some already had begun to make inroads and modified their rate reset provisions. So, in fact, an issuer that's a frequent debt issuer, and I would say financial services companies, REITs, utilities, energy companies probably are the biggest in terms of outstanding notional amount of floating rate notes. And if you were to look at how that divides, financial services is definitely the lion's share of the outstanding floating rate note exposure that's out there. Most of the floating rate note provisions are going to have that default to fixed. Some that are of more recent vintage, as in issued in the last 2 years before ARC came into play, before we had a hierarchy of LIBOR fallback provisions. We're going to have some different language where the calculation agent may have some discretion to set a new rate or to determine a new market standard rate if one exists. Calculation agents may be quite reluctant to exercise any discretion in that regard. So perhaps those fall into the same bucket of getting treated as fixed for remaining term to maturity. But it's important for issuers to take a tally, see where they are with all of their floating rate note language, see if they have the same language in their US SEC registered notes as perhaps they have in their Euro medium term note or global medium term note programs. Occasionally those differ, and that may present issues, and understand what the remaining term to maturity is for all of those. And then it's really a guess or in terms of which way the market's going to go. There are relatively few alternatives. We don't have sort of the negotiated alternative that Barbara discussed that exists with respect to bank agreements or the alternatives that Curtis is going to talk about in the derivative world. For a note issuer, the choices really are a consent solicitation. Most of the SEC registered notes are going to be subject to the Indenture Act provisions. And unfortunately, there's really no elegant way around that in terms of a rate change not requiring 100% of the outstanding note holders. Notes that were issued under GMTN or Euro MTN programs or 144A or 3A2 continuous issuance programs, those may not have been TIA compliant. There may not be a trust indenture. There may be a negotiated way to deal with those, which is why it's very important at this point in time to really assess what notes are outstanding, whether they were issued in SEC registered format where the Trust Indenture Act would apply, or whether they were issued outside of TIA compliant documents, and therefore there's a little bit more wiggle room. So for consent solicitations, obviously, depending on how the market determines the fixed for life rate that they may have on their instrument to a SOFR or SOFR-based note, they may be more or less willing to consent. And there may be some consent payment required to induce holders to consent if the issuer really wants to get all of their notes to a SOFR-based rate or to a different rate. So a consent solicitation is certainly sort of the least invasive of all of the choices that I'm going to outline, probably none of which is particularly attractive. Consent solicitation, I say, is the easiest because, again, no SEC filing associated with undertaking a consent solicitation. It is a negotiated or consensual arrangement. So even if there's a consent payment necessary, there's generally some back and forth with the note holders about what it's going to take to get the indenture amended. And of course, the difficulty associated with note holders that are just unresponsive and don't appear. So a consent solicitation may not be feasible from a practical perspective. Issuers are going to want to think about opportunistic debt repurchases. They may just want to go into the market, depending on what their overall maturity cliff looks like and their floating rate note, the floating rate note component of that, and selectively start repurchasing notes. Of course, that depends on having cash on hand. That may not be an option for many issuers, or it may not be seen as a prudent use of capital to go out and repurchase. If you're not going to think about either of those alternatives, you're really left with exchange offer or a tender offer. And we may, in fact, start seeing those at some point. I suspect, and if I had to bet, I would probably bet that most large or prolific issuers of debt are going to wait on all of these liability management choices until things are much clearer and until they determine what the large bondholder community, with the large bondholder funds, which way they're leaning in terms of keeping paper that's fixed for life at the rates that are in effect before LIBOR ceases to be a recognized rate or a published or quoted rate, or they see sufficient volume of issuance and so forth. I think we've seen a total of 8 supranational issuances take place, and that's probably not enough for a lot of the large bond funds to sort of form a view about instruments that are denominated or that are linked to the new rate. So I think definitely some difficult choices ahead. Yeah.
You can, except wait, I'm sorry, there is a woman who has been very, very patiently waiting to ask a question. And then when you're done, we're going to let you ask your question. Then I'm going to respond with some things that I think are also going to happen.
So I was just wondering, I practice in the residential area. And as you probably know, historically, a lot of our notes for adjustable rate mortgages have used the LIBOR. And what they say is if the index becomes unavailable, the lender will pick a comparable index. I don't know that anybody really knows what that means. We were kind of hoping that Fannie and Freddie would lead the way and decide what they want us to use because they have LIBOR products, as you probably know. Not hearing anything about that, was wondering if you have any insight on what's going on there, if anything, and where you think that might potentially be going.
Can you repeat the question?
Yes. So the question is basically when you look at an adjustable rate, a typical adjustable rate mortgage note, it does allow the holder, if LIBOR is unavailable, it allows the holder to pick a comparable index. And I think the question, correct me if I'm getting your question wrong, the question is really, what does comparable index mean is, and
me too. It's your other question too about when is it unavailable, and then what's a comparable index?
right.
Do you know if the industry, we were kind of hoping there'd be an industry response to that.
Yeah, and I think that what you've pointed out is sort of a bigger point, which is how interdependent all of these markets are. And, it's really incredible. When you look at, so again, if you've got underlying mortgage assets, you're regardless of what you want to do because LIBOR is going away, you also have to fund those mortgages, and you're going to fund an adjustable rate mortgage potentially with some floating rate debt. And so you probably want to have those match up to the greatest extent possible. And, again, this isn't just a problem with mortgages. I mean, this is a problem with everything. You've got floating rate assets. What's the typical way you fund floating rate assets? With floating rate debt. So if you've got a floating rate asset that's funding at LIBOR and then your debt financing is going to switch, then you've got a mismatch, and you've got basis risk between those. If you're hedging that floating rate risk with a derivative, you've got the potential for a mismatch if they're all dependent on one another. And of course, the investors in some of these transactions, they're also waiting. They're hedging their own positions, and they're dependent on some of these other markets. So it's another one of those problems that sadly, may not fully work itself out before 2021. Now, when you point to the adjustable rate mortgage, I think you're exactly right. When you look at the language, I don't know. First of all, I'm going to say right up front, as someone who never likes to shoot from the hip. I'm not going to shoot from the hip today. I do less in mortgages than I do in non-mortgage stuff. But, let's face it, Fannie and Freddie are more than, certainly more than half of the total mortgage market, and they have notes that have provisions that are identical to what you just quoted. And it would be great if they did lead the way, because then everybody would just follow them if they did this. And they probably will have some incentive to lead the way at some point. It just won't be 2018. And again, I don't have any reason to know this, but again, if I just merely looking at my crystal ball, which, as I've said, I need a new crystal ball because it doesn't predict the future as well as I would like. Somehow I have a feeling that it won't be at least the first half of 2019. I mean, they may make some statements because, there'll be somebody who gets asked a question and they, might in fact be prepared to have an answer. But it wouldn't shock me if Fannie and Freddie didn't decide what to do about any of this even during 2019. And I say that without really knowing, but other than the possibility that I'm confident that there is somebody at Fannie or Freddie who has attended a seminar like this. They must be. There's somebody at Fannie and Freddie who is aware that LIBOR is going away, and at some level, somebody is thinking about it. But I just don't know when they're going to announce what they intend to do. Let me. You had a question as well.
You probably covered the more interesting part of my question, which is the mismatch between, and particularly is the institutes a change, and you have hedging instruments and structured finance transactions, or not even structured finance transactions, and there's a mismatch there. The obligations.
Yeah.
The other less interesting question that I had in a rising rate environment, right? But think of plain vanilla debt without hedges. One would think the risk is on the investors if you have to fall back. The investors are kind of at positions as that particular case, the issuers who are looking to see.
Right. Well, so maybe to take that part, I'll repeat the question. First off, I'll do the second question first, so in a rising rate environment, I think rightly the observation is that investors would be worse off than the issuer. The issuer would have less incentive if you have the fallback provision that defaults to fixed for remaining term to maturity. The issuer is going to be less motivated to go out and undertake one of these, a repurchase, a consent solicitation, or something else. I think that's absolutely true. But for the fact that obviously most of the debt market is institutional, and the same few bond funds make up such a significant percentage of the buying market, that I think issuers who have a need to go to the market frequently are going to be quite reluctant from a relationship perspective to have disgruntled bond fund buyers. And just purely from a relationship perspective, we're going to think very hard about what they do in terms of having, letting that situation persist. On the second part of the question, you can certainly be confronted with a situation where you have mismatches, and this goes to your question as well. So on what is a cessation of LIBOR, I think, and here we can turn to Curtis, I think both ISDA and ARC have offered up triggers, what counts as a cessation of LIBOR, and for ARC, what to do in a situation where maybe LIBOR continues to be quoted, or you can eke out a rate, so something short of a full discontinuation of LIBOR and then, what you consider a complete cessation of LIBOR. Those may not be the same, right? You may certainly have a floating rate note or a structured note, and then the accompanying derivative that you were using to hedge becomes an ineffective hedge. But maybe this is a good time for you to talk a little bit about the ISDA consultation.
Sure. Yeah, and also this is a a rare moment where there's at least some emergent clarity as a result of ISDA's publication or announcement of the preliminary results of its consultation yesterday, in fact. So what I want to there are a few things to cover. I just want to skip. Actually, I want to. This is such a good slide title that I want to cover it. The fundamental conundrum of IBOR transition, which is that in the cash markets, the conventional wisdom is that there's going to be a pronounced preference for a forward-looking term rate, because that's the closest thing that there is to existing LIBOR. You've got 3-month LIBOR, 6-month LIBOR, etc. In the derivatives markets, the bulk of the liquidity needs to be in risk-free rates, so namely in SOFR and things directly computable from SOFR, not the forward-looking term rates, because if that's not the case, so the regulators say, we'll have recreated the original problem with the IBORs. We'll have a very thinly traded benchmark supporting a massive superstructure. And going back to July, there was a regulatory pronouncement from the FSB and some speeches that said as much. They said the derivatives markets should be not centered on the forward-looking term rates. And in fact, the FSB statement, they actually expected that most of the cash markets would also decide that they really didn't need forward-looking term rates. The ISDA consultation, which was released in July, was a consultation for some planned amendments to the 2006 ISDA interest rate definitions. The planned amendments would amend floating rate options for things like the Euribor. Actually, Euribor wasn't part of the consultation, but the British pound LIBOR and several other LIBORs. The need was for an amendment that would have a clear and objective trigger date, so there wouldn't be any argument about when the fallback was triggered. The consultation sought market input on 4 possible fallbacks for defining a term rate, and a number of possible fallbacks for introducing a credit spread. Yesterday, ISDA published the preliminary results, and those are subject to ultimate board committee approval, but the expectation at this point is that the rate fallback would be compounded setting in arrears SOFR, and that the credit spread adjustment would be a historical mean median approach that would look at a look-back period of where the credit spread has been over a past observation period. But in order to avoid a cliff effect, the credit spread would initially be set at the then current spot rate credit spread, and then over a 1-year transition period, it would linearly interpolate back to the historical credit spread. Now, although LIBOR wasn't part of that consultation, the preliminary US dollar LIBOR wasn't part of that consultation because ISDA felt there wasn't yet enough market data available on SOFR. The preliminary feedback indicates that the same methodology, the compounded setting in arrears rate, and the historical approach to credit spread would also be appropriate for US dollar LIBOR. So that's where derivative markets are going. In terms of the issue of how important is it to get alignment with the cash markets, I just want to, as Stuart pointed out, emphasize that the ARC timetable for publication of a term rate is end of year 2021. which leaves very little time to plan and adjust. There, apart from a number of biases toward the compounded setting and arrears rate, the view that the derivatives market may be coalescing there, the FASB pronouncement in October that designates the SOFR OIS rate as an interest rate benchmark rate for purposes of hedging accounting treatment. FASB declined to include any SOFR term rates in that definition, so that perhaps is another bias toward an OIS that sets in arrears.
But that said, I mean, when I don't mean to interrupt you, but FASB has pretty long-standing guidance on hedge accounting. I mean, at the end of the day, if you have a hedge that is geared towards a particular rate on an underlying asset or an underlying debt, and they are identical, it doesn't really matter whether it's on a list that FASB's put out. You still get hedge accounting if they match up precisely.
And for the benchmark designation, my understanding is important for fair value accounting because it gets the discount rate aligned with the valuation rate. Now, some of the reasons that forward-looking term rates are thought to be desirable primarily is that allows for advanced visibility of what the rate is. So at the beginning of the quarterly interest rate period, the issuer knows already what the rate is going to be 3 months from now, what it has to pay. Now that's valuable in some contexts, but let's think about securitization and structured deals where there's a waterfall and you only have to pay to the extent there's cash in the waterfall, right? That concern may be less important there. Also, if you hedge out of a floating rate exposure with a swap where the floating leg is the compounded setting in arrears SOFR rate, then as the recipient of that fixed rate, of that floating rate under the hedge, the issuer has solved that problem of advanced visibility, at least to the extent that the hedge providers perform. So those two cases, plus the thought that liquidity in the derivatives market is going to develop around the compounded setting in arrears rate, and therefore the ultimate cost of hedging, the hedging spreads would, in theory, be less where the liquidity is clustered, are all factors that maybe argue at variance with the conventional wisdom that we need to set a forward-looking term rate. The ARC hardwired approach for syndicated loans does go to a forward-looking term rate, and if that's implemented, then you do have a discrepancy between the two. And one practical observation, mostly for issuers, is to look at how your hedging covenants are drafted and look at whether you have the flexibility to execute cross hedges between different rates, still in compliance with the hedging covenants.
I mean, that sounds like a very significant tension point between the bank loan market and the swap market. I mean, we're talking about an entire market that's accustomed to forward-looking rates, and you're telling me this is going to be a rear-looking rate, right? I don't know, how are we going to reconcile those two?
I would just point out that this was exactly the reason why ARC invited other participants besides the derivatives market to participate in all of this, because all of the cash market participants said this doesn't work for us, having a backward-looking rate. And, this is why, again, almost as an afterthought, ARC has decided that they will come up with a forward-looking term rate, and it won't be out there until sometime in 2021. It may not. And remember, when they first said they're going to look at a term rate, they said, by the second quarter of 2021, and now they're saying by the end of 2021, but they might have a demonstrator rate, which is effectively sort of a pilot program, and who knows what that means and how that'll work. But I think it's very clear that, all of the other markets have given a lot of pushback on the idea of having a backward-looking rate because it just doesn't even make sense in the context of any of our existing deals. And, honestly, when, you're an ordinary lender thinking about pricing at LIBOR, you're thinking about pricing 1-month LIBOR on a go-forward basis, it is hard, even for the smartest among us, as lenders or as investors, to wrap our heads around the idea that we wouldn't actually know what our interest rate is until 1 month later or until a day later. It's just mind-boggling to even think that that's the way we would run the railroad. And so I think that, it's sort of funny, but when folks actually look at what they think is I'm going to go back to what I said about Category 1, Category 2, and Category 3 companies and bargaining power. I think that the folks who have the most bargaining power will sort of decide what they want, and they will do what they want as long as it exists in the market. The folks who don't have any bargaining power will get done to them, that's probably not grammatically correct, but you know what I mean, by the folks who do have bargaining power, whatever those folks with bargaining power want. But then there's kind of everybody in the middle, and they need for it to work out right. And what they really think, or at least a lot of folks really think, is that ISDA is the most likely to get this right. Why? Because, you have counterparties in the derivatives market who actually have relatively equal bargaining power. And the folks who are on one side of a trade may in fact be on the other side of a trade the next day. And as a result, it's more important that they in fact get it right. But the derivatives market is willing to work with, the derivatives market, let's face it, from the beginning of the derivatives market, they've always worked with notional amounts as opposed to real cash exchanging hands. And so I think that the derivatives market has the ability to cope with things that I think the cash markets have less of an ability to cope with. And where, again, my crystal ball, I think I've said lots of times, it's a little hazy and it's definitely not perfect. But I think that where we're going to end up by necessity is having a term SOFR rate because the market won't be able to handle anything else. And right now, I think most of the cash markets are expecting there to be a term SOFR rate, and they don't even want to think about the idea of pricing off a backward-looking rate. That.
Can I just ask a question?
You sure can.
Have you already determined that it's most likely...
If you can ask it louder, you can. Yell it.
I was saying that it has already been determined that the new rate will take effect towards the end of 2021. Do you guys have any visibility as to when we will concretely know that it's actually going to be SOFR? Right now, we're thinking that it's possibly going to be there, but no one can say definitely that it actually is going to be SOFR.
Yeah, well, that's actually a really great question. For those who didn't hear the question, even though she did say it louder after I asked her to, she asked, how do we know it's really going to, and correct me if I get your question wrong, how do we really know it's going to be SOFR and not something else? The short answer is I don't think we know that, but I think at this point there are enough resources behind SOFR and there is literally nothing else on the table. So, if you're competing, just like elections, if you're running unopposed, it's really likely you're going to win. And, what's running against SOFR? I don't really see anything on the table that's not SOFR that seems to have any chance of winning this particular election.
Can I have another follow-up question?
Sure.
So,
Louder, though.
I'm an originator of short-term bridge lending. So a lot has been said about derivative market and securitization, but for people like me who are sort of like in the middle, like you described, what are you guys seeing now that people are implementing in the documentation as opposed to just the general, we'll have a market rate? What are you guys seeing now that people are putting into the document to protect themselves?
That is a terrific segue to the stuff we actually most importantly want to get to before we're done with this panel, which is what are folks putting in documents now and what's the advice of what to do. And I guess I'll start it because I currently have the mic and nobody can shut me up.
If you could please just touch on every aspect, so on bilateral deals, on derivative markets, so that everyone here collectively can take something away from what their base is.
Sure.
So that's in fact what we intended to do, because, and that's why we have sort of all the participants in all the different markets. But I think that you have to separate two things. You have to separate the what to do now and the what you're going to do in 2021 and 2022, after LIBOR potentially goes away. At least in everything that I do, the answer for after 2021 and 2022 is really simple. And I'm simply not smart enough to know that. And my crystal ball isn't good enough to know what's actually going to develop in the market. I think we know that it's probably going to be some variation of SOFR. There will be some term variation, and that'll be what gets selected. So that really has a dramatic effect on what you want to do today if you have the bargaining power to achieve it. So what I think you want to do today, if you have the bargaining power to achieve it, regardless of what the market is that you participate in, is to be able to have the discretion on your own to make those judgment calls. And when I say make those judgment calls, the first judgment call is, does LIBOR need to be replaced? The second judgment call is, what exactly is the benchmark? The third judgment call is, what spread adjustments do you need to have? And when you look at all of those judgment calls, what you want to have ideally in your documents today, in your new deal, is the discretion to be able to make all of those judgment calls. And ideally, what's going to happen? The world doesn't stop in 2018. I mean, I certainly hope that there will still be a 2019 and a 2021 and a 2025 and so on. And you know what? Folks who are issuing securities or folks who are lending and borrowing money in 2018 and 2019 are probably also going to be borrowing money or issuing securities or lending money in 2021. And by that point, at the end of 2021, you will have a really good idea of what people at the end of 2021 will be doing, because it will no longer be the future. It will be the present. And you'll be able to just look at all the other deals on your desk or knock on the door next door of, the loan officer or the banker who's sitting next to you, or look at other comparable companies and look at the securities they're issuing, look at the loans that your neighbors are making. And there will, in fact, be something that either is market or not market at the time. And what you want, I think, is to be able to exercise the discretion to, you want to give yourself the flexibility today to exercise the discretion at that point in the future to do something that makes sense, and that makes sense at that time. And I think that, if there's one takeaway from me, at least, on what you're going to do on a go-forward basis, that would be it. And that's not really happening everywhere yet. So in my world, when I look at, for example, I look at lending in the securitization market, and the lenders in, for example, warehouse facilities are just starting to put in LIBOR language that gives them that kind of discretion. And they're just starting to get that pushback from the Category 1 companies who say, look, if you're a lender, that's great, but I'm somebody who has a lot of power too, and I'm not going to just let you unilaterally set a rate whenever LIBOR needs to be changed, or let you unilaterally determine that. And I don't want to take up all of the time from the panel, but I could talk a little bit about some of the back and forth that's been going on in transactions, what we've been seeing in negotiations so far. In securities offerings, right now. What we're seeing is that folks are terrified of making changes in their documents, because if they make changes, investors might not like it. If they do the same thing as they did last time, there seems to be no penalty in the market, and investors are buying those bonds. If they make changes, then they have to worry about whether investors aren't going to like those changes. So here's the really interesting thing. One very big floating rate investor popped up in the securitization market and suddenly said they aren't going to buy deals that continue to have the last LIBOR provision that could potentially turn their fixed rate deal into a floating rate deal, because they suddenly woke up and they said, wait a second, we might have a rising rate environment, and if I could potentially end up with a fixed rate deal, that would be terrible. I'm not going to buy that deal. And that has caused, particularly in the credit card markets, that has caused a bunch of folks to change their LIBOR definitions. And what have they done? They've provided more discretion. So you can look at, who are the folks who have done this? Citibank, American Express, Discover, Synchrony, folks who the market tends to trust, who are big issuers, have provided more discretion. Now, frankly, if you go out and look at their deals, they're publicly available. You could see what they've done in their LIBOR provisions. I would make I worked on the Discover deal, but I would make further changes to all of those deals to provide more discretion about when LIBOR goes away. And I would frankly want to add a whole bunch of exculpatory language to what they did, so that an investor who buys these securities, again, representing the issuer in those deals, so an investor who buys these securities, at least under the documents, has less of a right to sue me. If I do something that's completely irrational and is going to hurt investors, I'm pretty confident that those investors will still find a way to be able to sue me. But if I do something that looks a lot like the deals that I'm doing at the end of 2021, or the deals that other folks are doing at the end of 2021, what I'm doing at that time probably is going to look a lot more reasonable and probably a lot less likely to result in a lawsuit, but I'd still like to have that exculpatory language anyway.
I would say that in the floating rate market, the language in terms of LIBOR default provisions has become relatively standard. So you have, as Stuart said, more issuers facing reality and modifying their fallback provisions. So you have a fallback provision where the calculation agent has the discretion, more precise requirement. If there's an alternative reference rate that is selected by a central bank or some other governmental body, then that's considered the successor rate. In some cases, the calculation agent, if it's a financial services issuer and the calculation agent is an affiliate of the financial services issuer, the calculation agent does preserve some discretion, and presumably they won't be afraid to exercise the discretion. In other instances where you have a third-party calculation agent, so you have a regular corporate issuer that has a third-party calculation agent, usually an affiliate of the indenture trustee, they don't want the discretion. They want to be told what the successor rate is. And so you have a couple of different flavors where either an independent investment bank of national repute or something along those lines is selected by the issuer, and that investment bank or third party confirms what the successor rate is, so that the calculation agent has no discretion because they don't want to exercise any discretion for all of the reasons that our colleagues will talk about on the next panel.
Anna, why wouldn't you just have the issuer just do it? I mean, assuming that the issuer is somebody who has that kind of bargaining power, or they may call it a calculation agent, but what do you know? They're the calculation agent.
Investors just flatly reject that. That's not acceptable. Investors want, and investors more and more are asking for the ARC waterfall to be incorporated in the notion of identifying whether there's a definite cessation or discontinuance of LIBOR, whether LIBOR can no longer be relied on. So that kind of, they want something that's seen as more objective. All
right, so in the securitization market, as I said, almost everybody has been really gun-shy about the idea of making any changes. But those who have made the changes are folks who are, some of the strongest issuers in the market. And the strongest issuers in the market have, they've talked to their trustees. Their trustees have said, as you just said, Anna, they want nothing to do with making any determination. So there's no third party who they are willing to trust as much as they are willing to trust themselves. And I can't necessarily speak of the thought processes of, Citibank or American Express, and I won't speak of the thought processes of the clients that, we've worked on where we've done these transactions like Discover. But I think that if you're speculating, folks who are big issuers who go to the market a lot, they sort of rely on investors understanding that you only have a limited ability to hurt investors. If you were to hurt investors, investors will make you pay in some way, shape, or form, probably with higher pricing on some future transaction, or they'll be less eager to buy your deals. So at least the strongest issuers in our market have been willing to, and not only willing, but have sort of wanted to take that discretion on themselves because they don't want to give that discretion to somebody else.
Yeah, that's just not the case in the just floating rate market.
And I will chime in on the loan market. Again, I am seeing fairly standard provisions amongst large and small, or strong and weak borrowers. The banks, I think, are really holding the line as a group to have their provisions standardized across the board. And in most cases, as I outlined a little bit earlier, you have a procedure, again, fairly well baked no one's going to SOFR. It's an amendment process. It's the borrower and the administrative agent negotiating in good faith to come up with an amendment. That amendment is going to be proposed to the lenders. It has to be not objected to by required lenders. If you get an objection, you're going to wind up defaulting to your base rate, which is expensive for the borrower. So there's going to be some pressure on the borrower to be, again, I guess, reasonable. But that is really what I'm seeing almost uniformly across the board.
I think that's right. And, when I look at the warehouse facilities that we do, in the bilateral transactions, almost every lender, every renewal that happens has got now a LIBOR replacement provision. And the LIBOR replacement provision usually gives a lot of discretion to the lender. Often the borrowers are negotiating something that might add something like, about market acceptance of whatever the lender does, so the lender doesn't have complete discretion. We've seen some borrowers who themselves are Category 1 companies who've given more pushback, and, they've asked for at least something that might be kind of like most favored nation. As you can imagine, the banks are never agreeing to that. But, the idea of being willing to say that they're sort of generally doing something, that's, that I've seen in a transaction or two where, we've had where there's been pushback, and at least, the borrower and the lender have agreed that, it would be something that would be comparable to what the bank is doing in a more general way with others. And rather than having the bank have complete discretion. But literally, at this point, almost every bank has form language that they're putting in, every renewal of every facility or every new facility. And, the negotiation, it's getting into all the loan documents now.
George, does that documentation cover both the base rate and the spread?
It covers everything
Yes.
that would happen when, exactly right, yes. And it doesn't distinguish. It's just the what would replace LIBOR. Yeah, as Barbara said, short answer, yes.
What would replace LIBOR doesn't go to the question of the LIBOR plus 50 or 75, right?
You're correct, it does not. And
Right, but the language covers it includes not only the benchmark, but the margin.
bank has discretion on all of that.
There was a
There was a
question.
question.
Yeah, sorry, there was a question. Little louder.
In the residential market, and the homeowner borrow mortgages at the LIBOR plus a spread, and when the banks negotiate with the renter, can each individual homeowner will pay the same fee, or can each individual homeowner can negotiate with the bank about consumer protection, it's something of a thing that appeals to like homeowners.
All right, I'm going to try and, if I heard that correctly, I'm going to try and repeat the question, which is in adjustable rate mortgages, does sort of every homeowner potentially get a different rate? Is that really what you're asking? And I think you're really asking also what's the consumer protection regulatory aspect of the lender just sort of changing the rate. So, the person next to you who you may know, and if not, you should introduce yourselves to one another because you have similar questions. All right, so, if you look at a typical adjustable rate mortgage note, it gives the holder of the note the ability to adjust the benchmark. Now, first, there's an interpretive question, very real interpretive question. Does that also allow you to tack on an additional spread in order to adjust the benchmark? And I think that will be a subject of the next, maybe that'll be a subject on the next panel, I'm not sure, when the litigators talk. But I think that what's going to happen there is, it is possible that different lenders will have different benchmarks and the holders will wind up getting stuck with different rates. And there could end up being some governmental action that results from that. I mean, one could imagine that. I think our consumer regulatory lawyers aren't really, there's enough flexibility in the adjustable rate mortgage notes that I've asked this question to our regulatory lawyers, and I'm not a regulatory lawyer, but they don't seem to be very concerned about this at this point. I've asked them, do you think of this? I've asked them this very question, and I've asked them, do you think of this as a big problem or a small problem? They won't, or no problem at all. They won't say it's no problem at all, but they think of it as a small problem rather than a very large problem because there's enough discretion in the mortgage notes. And once again, Fannie and Freddie who are more than half of the market are probably going to have something to do that won't be unreasonable. And when others follow what Fannie and Freddie do, it's probably not going to be a big problem.
Yeah, and I talked to Larry Platt about it.
Oh, there you go.
Larry's trying to get Fannie and Freddie to focus more on it. So far, he's getting here. But Q2, I think, is leaning towards there's going to be an industry response, and everybody's going to do whatever.
I also talked with Larry Platt about that, by the way, and he's one of our regulatory partners as well as a few other of our partners. But yes, you're exactly right. That's what he told me too.
So at least in Europe, and we're probably out of time, but at least in Europe, what's been discussed by the EBA and other national regulators is essentially imposing some kind of punitive cost to banks who don't transition away from LIBOR. So whether, that's some additional capital requirement, some additional something that makes it, necessary for them to move to SONIA or whatever the rate might be in Europe, and for us to move to SOFR, presumably there'll have to be some general move that way, right? Just the Fed guiding people is not going to be enough.
All right, I think we probably are out of time. Please, we're going to have a short break. Let's say 10 to 15 minutes max, and then come back for the most important panel of the day.
Start by lowering expectations a little bit for this panel, given all of Stuart's hype about this third panel over the last two panels that you've heard. But I won't. We'll try to live up to Stu's expectations and yours. We'll introduce ourselves in a moment. Just one announcement that the slides that you've seen today and that you'll see during our panel are going to be made available to you. I think by email. You will get a note from one of our colleagues, and you'll have them to review at your leisure. So just by way of introduction, my name is Matthew Ingber. I'm a litigation partner here in the New York office. I've been at Mayer Brown actually my entire career for about 20 years.
Hi, my name is Chris Haupt. I'm also a litigation partner in our banking and finance litigation practice in New York. And I too have been at Mayer Brown for my whole career. I specialize in financial products litigation, and lately I've done a lot of representations of securitization trustees.
Hi, I'm Sagit Tamir. I'm a securitization partner here at Mayer Brown, and I've been at Mayer Brown all of my career in the U.S.
All right. Sagi was a litigator in Israel, right, Sagi?
Yeah.
Before he came to the U.S. and has done structured finance, securitization work for the last several years. And we actually have worked together. You might find it odd that you've got some litigators and a transactional lawyer on the same panel, but over the last, 8 or so years, Sagi and we have worked really side by side, representing securitization trustees and others in connection with issues arising out of the financial crisis, in particular RMBS litigation. So I think we have some insights as litigators on the issues that Sagi deals with every day, and Sagi certainly has some insights on the litigation matters from the transactional perspective. So hopefully we could share some of those thoughts today in the context of this LIBOR issue. So Sagi, you want to get started?
Sure, it makes sense that I'll start, given that we always advocate that transactional practices, right, create the business development of the litigation a couple of years down the road. So I'll kick it off, and you've obviously heard until now. We talked a lot about what folks are doing or should be doing for their new transactions. In other words, having transactions that don't have issues that will cover to some extent that we will cover, but that is a privilege that many transactions, legacy transactions, and we will mainly discuss what we would call long-term legacy transactions, and by that what we mean is transactions that reference LIBOR, regardless of the product, that were entered into before the concept or the being terminated forever was top of mind. Drafting of those transactions did not expect or foresee such an event. And by long term, we mean that they will remain or mature past 2021, because obviously if they mature before, that's less of an issue. And the challenge in these deals, which we will get into, is that while many of them do have fallback provisions with respect to LIBOR, those fallback provisions were drafted more where people were envisioning a temporary fluctuation or unavailability really of LIBOR. So they were drafted more with the purpose of just making sure that the particular transaction doesn't come into a halt, into a stop, an unintended stop, but rather it can continue going, and notwithstanding this temporary, short duration kind of event. And so that's one thing important about those deals, that the fallback provision really foresees a temporary issue. And then with that in mind, also the triggers of those fallbacks were drafted kind of thinking about the same kind of situation. That was what was in mind. What if I just can't get LIBOR from the particular publication I'm looking to usually take it from? And then what really kind of brings it all together to why that's a real issue for those deals are the amendment provisions. And, prior panels explained how even the amendment provisions are being revised now for new deals so that you have exceptions to the general rule that sacred rights require unanimous consent. So when you look at new deals, you'll see that depending on the product, generally there's an exception to that. There's like a alternative base rate amendment provision or an exception so that you don't fall under the unanimous or a very high level of consent required. But the legacy deals don't have that. And so they both have, again, triggers and fallback provisions that envision a different situation than the one that we would face 2021, or the end of 2021. and they're very, very difficult to amend, if not impossible. And that, of course, depends. It's easier to amend if it's a bilateral contract, but then when you start moving towards broadly syndicated loan agreements, so those credit agreements, and obviously moving into securities, and again, it varies. You've heard there are options for exchange offers, etc. But if you move to structured finance securitization, not necessarily you'll have it in all products. And of course, there's products where it's easier, the CLOs, because of the way they can refi and reset. There's ways to address that. And also CLOs have been putting language that is kind of ready for LIBOR cessation in the last year or two. So it's really depending and turns on products. And so just to give maybe two examples of why this matters, and the short of it of why this matters is really that because you got provisions that are intended for something else and you're kind of stuck with them, then the consequence can be one that is unintended and, more importantly, one that transfers value. And when there's a transfer of value which is unintended, there's obviously winners and losers. And you can assume that those that are getting the short end of the stick will probably not be happy and might look for some action for relief if they believe they're injured.
Sagi, can you give an example of how this transfer of value would be effectuated in a particular deal?
Yeah, definitely. So, for example, if we would think about a securities offering, and let's say that a typical indenture provision for a note that is LIBOR referencing can basically say that you first look to the reference page of a particular publication. And so it might be Reuters or Bloomberg or Wall Street Journal. But if for any reason it's not available, then, and again, in mind, there's just a temporary kind of hiccup here, right? So the next one typically would be, then can you calculate your own LIBOR? In other words, can you just get quotes from reference banks and calculate LIBOR? But what is the expectation is that if LIBOR is terminated, banks, for example, because banks will no longer be required to provide quotes for LIBOR calculation, it is probably reasonable to expect that banks will not just provide quotes for kind of privately calculating LIBOR. So you might not be able to benefit from that fallback, and then you would go to the ultimate fallback for these kind of transactions, which basically say, well, you just use the last reported LIBOR. And that made a lot of sense for something that is short duration. But what it would mean here is that your floating rate instrument has just turned into fixed rate instrument. And now it all depends how rates kind of move in the market. If they move against you, then your fixed rate would, then your fixed LIBOR plus spread, which was now always looking to the same LIBOR, the last reportable LIBOR, might be lower than what you would otherwise have gotten, which means you hold the short end of the stick. And if it's just a regular, class A, class B transaction, then whoever is the residual is profiting, and vice versa, right? If the market moves, in their favor, you might get paid less than you would otherwise get paid, which means the residual gets more. So it's really somebody's going to benefit from it, and somebody would not. And you can think about the same kind of similar situation in credit agreements. So if you brought a syndicated loan, the waterfall is a little different, but again, you would look for the relevant page, and if it doesn't exist there, there would be this privately calculating LIBOR, and then it will usually fall either to prime or to some other lender favorable rate. And so that now you get the borrower is really paying more than expected, but not for a very short duration, but for the rest of for the rest of the term, and so that's an issue. Another issue just to take into consideration here is that because of the way the triggers were set up, they might not even pick up the fact that there's an issue. And the best example to that is that if LIBOR is continued to be reported, what people call zombie LIBOR, then, and the trigger is that you're only going to the next level if you're not able to get your LIBOR from the publication that is in your document or a similar or successor publication. The way to read your document might just mean that LIBOR that is continued to be reported alongside SOFR and all other alternative base rates is just satisfying your document. And therefore, there's no event at all, and there's no transition at all. And so that in and of itself is an issue. And I would say that for securitization, this is compounded because there you have all kind of mismatches that we've discussed, or our prior panels discussed, but obviously you can have the asset side of the securitization either not transition or transition, whereas the liabilities, the ABS, are unable to transition, or they just don't transition to the same alternative base rate, and there you suddenly have a base rate that you did not expect. And that put a challenge in whomever is required to actually calculate LIBOR. Are they just to follow language that might otherwise be looked at as very clear and unambiguous? Or do they have to do something else because they know that the result is probably not the intended and correct result, in particular because they're not living in a vacuum? I mean, we're seeing what's happening now. There is a process where new deals are changing the language so that you don't end up with that result. And so if you have a few years where you have new deals and those new deals will behave very, very differently, then it puts pressure on whomever is calculating because, yes, it might be exactly what the document says, but the risk is it's not what was intended. So it's broken in a way. And here, you know, those that are injured would probably be able at least to raise concerns or threats that whomever is handling this is not doing what they need to do because there's an impossibility or there's a frustration of purpose or there's just a mutual mistake. And again, if you have a bilateral agreement, it's easier to address. If it's a club deal and the relationship matters, you would expect things to be addressed. But the broader the product has been disseminated, the harder it is to address it. Yeah, sorry.
Could I ask?
Of course.
So for legacy long-dated deals where the fallbacks only go to temporary cessation, so an event reduced screen rate, what are the likelihood of success of a contractual illustration claim under New York law, would you say, for those older deals?
That I'll let my litigators address.
Well, you know, the litigator's answer is always 50-50. I mean, I think the doctrines that matter are what Siggy said. It's things like frustration of purpose that, you know, we had this fallback provision with one thing in mind, and we weren't intending to use this contract language in this context where LIBOR is gone forever, or mutual mistake, I think, would be the same idea. We were both under the impression, which turned out to be incorrect, that LIBOR would be around forever subject to some temporary hiccups. And so this would seem to fall into those kinds of doctrines. New York courts, though, especially the commercial courts, I would say, are very reluctant to apply those sorts of, you know, you can call them defeater doctrines. They especially the state courts, is my impression, they like to apply contracts. They can interpret the text, and they think that parties rely on the text of the contracts. And so I think that, although it might be a textbook example of those kinds of common law doctrines applying, I think that will face resistance in New York state courts. You know, another wild card to throw in, though, is not all of these are New York law transactions, and certainly not all the litigation will be in New York. And if you have courts in other countries or other states doing different things, that's another source of uncertainty and risk. I mean, that's not a very solid answer, but I think that's the best that we can do. Is that you could certainly expect to have contracts that on their face are perfectly clear about what to do in a certain situation, but that has to be read against the backdrop of, is this really the factual context in which that was intended? And that creates uncertainty about whether it's enforceable.
But as a general rule of thumb, you're saying that the New York courts would resist trying to find a contractual frustration even in this scenario?
I mean, those are valid New York contract law doctrines. But I think especially, I mean, Matt will have his own experience, but my experience is especially at the trial court level in New York County in the commercial division, those are courts that do not go out of their way to avoid the plain language of the contracts. And I think that they will apply those doctrines if they have to, but I think that they will be resistant to that.
Yeah, I agree with Chris. If the language says you're to use the LIBOR rate that's published on Reuters on a given day, and there's something on Reuters that says LIBOR because some banks voluntarily submitted rates to allow for a published LIBOR rate, even though it's different in 2022 than it would be today. I could certainly see especially some of the state court judges in the commercial part saying, this is what the contract says, show me where that ambiguity is.
And I think that's
in the zombie context. I can see that it would be difficult to find contractual frustration. But in the different scenario, I guess there's cascades of this, but if there's a permanent cessation, I guess maybe that's edging towards maybe applying those doctrines, because even if you follow the plain wording of the contract, it doesn't, unless it's falling to a fixed rate, which then there is a solution, they'll apply that. But in lieu of that, I think it'd be difficult to say that the New York courts wouldn't, right, in all scenarios.
Yeah, I think the question is if you have a fallback that is use the last LIBOR, and that's you can explain the purpose of that was we thought the last LIBOR would be from yesterday, not from 5 years ago, then that's the situation where the contract is clear, but it's also clearly not what was intended. If there is no, if you're talking about applying, a zombie LIBOR versus, I guess there are two different issues. Is there a current LIBOR that continues to be published, which is not LIBOR the way that we imagined it? That creates one issue. Whether you use the contractual fallback or whether you can say we can ignore that fallback because it wasn't intended here, that's a different question. I think in the zombie context, it is really difficult because I think it would be argued that the purpose of saying, look at this Reuters page was precisely to avoid this kind of argument that, oh, that's not real LIBOR. It's, we're not arguing about what's real LIBOR. We're arguing about when you type in this ticker, what pops up. And so that I think is an even harder argument for frustration of purpose because you have, you have parties that went out of their way to not come up with something that kind of is reasonable and makes sense, but something that's very explicit and clear, and there's either a number on that page or there's not.
Make the point a different way. If there is a lot of contracts out there that have no fallback at all, right? And if it just says use LIBOR and LIBOR doesn't exist, you have clear frustration.
If it says use LIBOR and the way that LIBOR is defined is something that doesn't exist, then you would, before you get to frustration, I think then you would go to whatever the contractual fallback is, if there is one. And if there is none, then yeah, you're in different territory. Okay, so I think, all right, so when we try to think about how and where litigation will come out, and I know a lot of the earlier panels were focused on, or they had subject matter experts on specific products. This is going to be a bit more general, and the first thing that I would look at is, how are people going to be injured, or how are people going to claim that they're being injured from using the wrong LIBOR, whether it's falling back to an alternative when they think you shouldn't have fallen back, or using the wrong alternative. one is obviously just the interest rates are different. I think the rate should be 5%. You think it should be 4%. And so you have a dispute between a rate payer and a rate receiver. In principle, that can be fixed with if there's an agreement that there needs to be a shift to a different rate. That's a question of what's the spread or what's the benchmark to fix that kind of first order difference. But that's certainly an obvious source of large potential damages. But I think there are more subtle things as well. I think Stu talked about this in the first panel. Just looking at the difference between LIBOR and SOFR, the absolute rates might be different, and that's important. But they also have a lot of other different characteristics. One is a bank funding rate. The other is more of a risk-free rate. And so they behave in different ways. If there's a bank crisis, LIBOR goes up and SOFR goes down. And for certain kinds of participants, that's really important. Whether they're forward-looking or backward-looking, what the term structure, whether there is a term structure, there's an expectation, as I understand it, that SOFR as an overnight rate will be more volatile than LIBOR will. And so these are not all things that you can fix with a spread or with contract language. It's SOFR plus 50 basis points, plus if there's a bank crisis, add another 50 basis points. That doesn't really work. And then also just the history of LIBOR. It's a number that people are familiar with. People have data on it. People know how it behaves. And SOFR, or whatever the alternative benchmark is much more of a wild card. And so I think people could claim that they are injured not just because the rate is different today, but because it's going to behave different ways. It will have different volatilities. It will be correlated with things in different ways. And that could be a source of disputes, especially when those differences are concentrated in particular transactions, which I'll talk about in a second. The third source of risk, I think, or source of damages, I think, is a little bit different. The first two are comparisons between one rate and another. The third is more about the transition from one to the other, and that is if you have, let's say, a floating rate loan that the borrower has hedged with an interest rate swap. I'm paying LIBOR plus something on the loan. I'm getting LIBOR on the swap. I don't care whether it's LIBOR or SOFR, or it could be the lottery numbers, as long as it's the same thing on both sides. But if the loan changes to one thing, it has a fallback or it has an amendment, and the swap, which is with a different counterparty, has a different fallback or a different amendment, then all of a sudden, where I thought the exposure was zero, now the exposure is not zero. And so even if that's a small difference, in absolute terms, maybe it's just a few basis points, or it's a different difference in a correlation. But I thought that there was nothing there at all. And if I have a large enough notional balance, those kinds of bases can be really important. Another example would be in secured lending or securitization, where you have floating rate collateral on one side and you have floating rate notes on the other side. Of course, if one side goes to prime and the other goes to last LIBOR or something, dramatic, then that would be a problem. But even if you have perfectly reasonable fallbacks on each side, if they're different and the structure assumed that they would not be different, then that will create problems. That's not the way that the deals were modeled. It's not the way that they were rated, probably. And that can create an additional source of loss. The last panel talked about what might happen with consumer loans. You could have regulatory overlays. You could have different servicers applying different standards and not necessarily thinking about what's happening on the transaction side, and that could generate a problem. And I think generally this category of basis risk and the gaps between related transactions is one that will be hard to deal with, because the industry groups are all working very hard on this, but they're working on their siloed products. And so LSTA might come up with something for syndicated loans, and ISDA comes up with something for swaps, or SFIG comes up with something for securitization. And that's all great if that's the only asset class that you hold. But if I'm hedging my syndicated loan with the swap, and either the industry groups or just market practice go in different directions, then somebody is going to profit and somebody is going to lose. There's going to be value transfer, as Sagi was talking about. Another set of high-level points, when we think about, where is litigation most likely to happen? Of course, the markets are huge and LIBOR is everywhere, but it's probably not going to be litigation apocalypse where just every legacy deal goes into litigation. There are probably some things that are more likely to involve litigation than others. The number of parties on each transaction is important. Obviously, you can have bilateral disputes that don't get settled, but it's much harder to come up with a reasonable amendment or a resolution when you have dozens of parties in a public debt deal, or when you don't know who the investors all are and they're changing all the time, and there can be opportunistic behavior. There can be holdout behavior if we can get 99% of the holders to agree to an amendment that requires unanimous consent, but the 1% realizes that he's the holdout. That can create strategic behavior that's more likely to lead, if not to litigation, at least to resolutions that are economically costly to the other parties. Another factor is types of transactions that concentrate exposure to particular aspects of interest rates. So an example would be an interest-only tranche in a securitization. Maybe all of the other holders agree that SOFR plus whatever it is, and we can come up with a reasonable spread. That's good enough. We don't know exactly what it'll be, but on average, it seems reasonable. But the IO holder, the only thing that he gets is interest, and maybe the only thing he gets is interest above some threshold. And so he's going to be laser focused on exactly what is that replacement. And that kind of party, I think, is more likely, which will often be a small minority within the transaction, they might be more likely to litigate than the more vanilla kinds of securities. Another example would be in interest rate derivatives. If you have a derivative that pays the spread between two rates, and you have a reasonable backup on each side, but the spread between the backups has different characteristics from the spread between the original rates. That's something that's going to magnify these small second and third order effects, especially when they're part of large, complicated portfolios that are hedged in complicated ways. They'll tend to make things break. Or if you have a cap type transaction where I get paid if the rate goes above a certain level in a certain month. So I care a lot more about volatility than I might if it's just a loan, for example. So there are certain kinds of products and certain kinds of portfolios that might be more likely to generate litigation risk. The last point that I have here is investor constituencies, and in particular, we've seen certainly in post-crisis litigation that there are investors out there who will try to bet on contract interpretation issues, who will go through 100 securitization deals and say, this is the one with that has some squirrely language about how the fallback works. And so this is the deal where I'm going to buy the residual, or I'm going to buy the IO, or whatever it is. And I'm going to assume that the trustee, that all the other investors and the trustee are thinking that this deal is going to work the same way as the other 500 deals that they're doing. And this is the one that I'm going to concentrate my portfolio in and either threaten to litigate or to litigate. I think Sagi sort of alluded earlier. Another factor that might mitigate litigation risk is there are some transactions that are callable. There are transactions that are shorter term. There are transactions where there's an out if they start to have problems, and those are probably less problematic. But some of the, like we've seen with RMBS, the longer term transactions are the ones where there's the greatest reward for fighting over payment provisions. So here are a few scenarios for who the plaintiffs and the defendants are. Again, to start with the obvious, if there's a rate payer and a rate receiver, that's an obvious source of dispute. And if on the investor or lender side there's an agent or a trustee, they will tend to be the focus for those sorts of disputes in their role as calculation agent. Another wrinkle in this scenario is that for public debt deals, Section 316B of the Trust Indenture Act says that holders' rights to payment of interest and principal shall not be impaired or affected without their consent. And that had, I think, historically been viewed as more, amending the legal terms of the contracts. But there have been some cases in recent years that suggest that in the workout context, if the economics of the transaction change enough, that can be treated as an impairment of the right to receive principal and interest. This, I think, is sort of the opposite. If obviously changing the interest rate is within the scope of 316B, but I think the argument might be, well, we're not impairing your right to receive interest. We're replacing a rate that doesn't exist, which is what you're entitled to, with what we think is the closest thing to that rate, and we're trying to preserve the economics of the transaction. So there might be arguments about whether that's an impairment or an effect on the right to receive interest, and that's not all that different from just standard contractual provisions that make interest a sacred topic that requires unanimous consent. Within the investor sort of side of the transaction, certainly as we've seen with RMBS, investors have focused on trustees, or they might focus on administrative agents in syndicated deals. That might start out in disputes over amendments and whether particular kinds of amendments require particular kinds of consents, whether they're things that the trustee can rely on a direction or they can rely on an opinion of counsel, who are the adversely affected parties whose consent is required. They might start out that way. Of course, they could also include simply what is the rate and arguments about what the contract means or whether the contract should be applied literally. And it also, in some transactions, will get into this fundamental dispute that is still not really resolved after the financial crisis of, like, what is the role of the trustee? Is it a neutral administrator, or is it the champion of the investors? Is it supposed to be fighting for a rate against the issuer that's the best rate for the investors, or is it supposed to be trying to do something reasonable? It might depend on, are you called the calculation agent, or is the calculation agent function wrapped into somebody called the trustee? I think that will at least change the rhetoric in some of these cases. There's the possibility of suits against investment advisors, people who have constructed complicated portfolios for clients. And as I was talking about earlier, you have what you thought was a hedge, and the hedge doesn't work the way you thought it did. Should the advisor have known about that in advance? A related topic would be lender liability type claims in the floating rate loan with interest rate swap structure that I mentioned earlier. There were a bunch of cases about 10 years ago where the borrowers prepaid their loans, and then the banks terminated the swap because that was a termination event in the swap, and the borrowers were surprised to find out that they owed swap termination payments. And they said, well, there was no prepayment penalty in the loan agreement, but I'm prepaying the loan and I'm having to pay a lump sum of money. And so that led to litigation, which the banks mostly won. But I think that same kind of idea that the borrower thinks of that as one transaction that's supposed to work in a particular way, I think that's another possibility. Certainly, securities disclosure claims are possible if what is sold as a floating rate security suddenly turns into a fixed rate security. That seems like it might be material. But also if there are risk factors relating to the way that particular fallback rates work that were not disclosed, investors could try to bring claims on that. And part of that will depend on the vintage of the security. Was this issued at a time when anybody had any idea that the demise of LIBOR was possible? And then, as a segue into what Matt's going to talk about, I think all of these, maybe not all of them, many of these could be brought after the injury occurs, but some of them might also be brought in advance. We see that something is going to happen with LIBOR. We're going to try to resolve that consensually, but if we reach a point where we realize the parties have a disagreement, maybe both sides will agree that it makes sense to resolve that in some sort of declaratory fashion or a trustee instruction type proceeding.
Right, and so picking up on that point, I think the last thing that transaction parties want, and especially calculation agents or trustees, to pick up on Sagi's point, is to have a scenario where it is the calculation date and you have somebody sitting in the analytics group saying, okay, this is what the contract says, and it says to use LIBOR that's published on Reuters, and I see here there's something that says LIBOR published on Reuters, but it's not the same thing that we were talking about a few years ago. What do I do? Or there is no LIBOR, and they go out and try to get rates from reference bank, and they're reference banks, and they're having difficulty doing that, and they call up the legal department and they say, what do we do at this point? I think we can all agree after everything we've heard today that is a scenario that all transaction parties want to avoid. So what can we do about that? Another theme, by the way, that's clearly emerged, I think, from today's discussion is that there are going to be winners and losers. Sagi gave one specific example of that, but there will be winners or losers. There will be opportunities for opportunistic behavior by investors and others. And that is unfortunately a recipe for litigation, potentially for litigation. So and we only have a few minutes, and I actually want to leave a few minutes for questions. So let me just address briefly what should we be doing now? And some of what I'm going to say may seem obvious, and some of what I'm going to say may be something that you're already doing in your own institution. But it seems to me that the first thing that we need to understand is that this is not a 2021 or 2022 problem. This is really a 2018 and 19 issue, and it needs to be addressed early. It needs to be addressed now, and you have to understand what the scope of the problem is. So in each of your institutions, if this falls within your area of responsibility, you need to look at the portfolio of products, and you need to create categories by product. And then within each product group, we would suggest that you look at the contracts, and probably every one of the contracts, and categorize those contracts. Look at what the reference rate is in those contracts and categorize by fallback language. Take a look at what the amendment language says. We've talked about how amendments are a real solution in bilateral deals or deals with a reasonable number of parties. Much more difficult when we're talking about hundreds of note holders or thousands from whom you need unanimous consent to amend a sacred provision like the interest rate. I'd also look at indemnity language in these deals. Okay, if we are right that litigation is a distinct possibility, whether you are one of the parties who might get sued, or you're one of the parties who might be indemnifying the party who's getting sued, or if you're an investor and it's, say, a trust indemnity, so you're going to be indirectly impacted by that, but impacted nonetheless, you I think, want to take a look at the indemnity language in these various deals and figure out who's going to be going out of pocket for this. In the smaller deals or deals with smaller counterparties, obviously engaging with the other counterparties is a good idea. Much more difficult in the larger deals. And in those larger deals in particular, I expect that we're going to see the parties who are most likely to be sued. And I agree with one of the first things Stuart said at the outset of our discussion today. I do think that calculation agents and trustees are going to be caught in the crossfire here. I think there's real potential for that to happen, and we could all say, you know what, the trustee doesn't have a dog in this fight, right? The trustee shouldn't be at the epicenter of this dispute, but there were a lot of trustees who were saying that coming out of the financial crisis. We, on behalf of trustees, are saying this all the time in a massive number of litigations that have been filed against trustees on the point that Chris was talking about. What is the role of trustee? But given the role of the calculation agent here, and given the decision that the calculation agent is going to make, and given the fact that no matter what that decision is, there is going to be a winner and there is going to be a loser, trustees and issuers and sponsors and others need to expect that there will be some litigation, and they have to ask themselves, what can we do about this now? One option, as Chris mentioned, is a declaratory judgment type action. Now, there's certainly question about whether that is the right approach. That could be, a litigation, and I'll get into a little bit of the mechanics. That could involve just a number of parties fighting about a lot of different issues, and it could be a little bit messy. But from the trustees' perspective, especially given that they don't really have an economic interest in what the interest rate is, what that determination is, they might decide that that is the best way to get resolution of this issue and to reduce their exposure. Issuers might say the same thing. Investors might say the same thing. I mean, they all arguably have rights to initiate this type of proceeding to get an early resolution of these issues. Now, if you go in today to try to get resolution, I could see a state court judge who has a docket that is up to her or his eyeballs saying, it is 2018, why are you bothering me with this now? Okay, so maybe it's a little early right now, especially when we haven't developed a new market standard yet. But if you go in 2022 and say, Judge, we need a resolution of this issue and we need it right away, that same judge is going to say, why did you wait so long? You should have been here a year ago or 2 years ago when you could have anticipated this issue. You should have been here. We could have done this at a more leisurely pace instead of coming in here seeking emergency relief. So the key is striking the right balance. What is the right time? And I'm not necessarily suggesting this is the solution to the problem in these transactions with multiple parties, but it is a solution, and it's one that I think this group should consider a real possibility, whether you work for trustees or issuers or investors. That proceeding, and then I'm gonna wrap up, and we'll have a few minutes for questions. That, like I said, that proceeding has some value really to all the parties involved. The way it would play out is that there would be a filing by one of the parties, and you would raise the issue for the court ahead of the end of 2021, and you would say, Judge, we just need direction on how we should calculate the interest rate under these circumstances. And interested parties would be invited to attend. There could be a lot of people showing up in court to weigh in, but that's what the party who would be the eventual defendant wants. You want to give people an opportunity to be heard, and you want the court to consider all of those varying viewpoints in advance of that declaratory judgment action, or it could be something called a trust instruction proceeding. We would advise parties to give notice to the affected parties before going into a litigation. Make a decision about what the reference rate is going to be based on your reading of the contract, based on the developing market standard. Send a notice to investors and other interested parties and say, this is what we propose doing. Maybe you could seek unanimous consent for an amendment. It's unlikely, for the reasons Chris and Sagi have already mentioned, that we're going to get it. But if you're not going to get it, at least when you go into court, you can say, Judge, we made a decision based on what we think is a good faith reading of the contracts and what we see as a developing industry practice. We gave notice to the interested parties. We got objections to what we were going to do, and so we feel compelled now to file this litigation to give everyone an opportunity to be heard and try to get resolution in advance of the end of 2021. And if you're sitting there thinking, wow, this could be really messy, it could be really messy. But we've talked a lot about all the possible solutions today, and it's really easy with these bilateral agreements. It's a lot more difficult when we're dealing with transactions that involve multiple parties. And so we raise this because it is not inconceivable to us that transaction parties think along these lines over the next, I'd say, 12 to 18 months. With that, I'm gonna stop and yes.
Todd, I mean, well, I agree with you that in terms of dollar amount, it's maybe smaller. In terms of the party that needs to make the decision, right? If it doesn't matter that on a deal by deal basis, it might not be the largest amount. But if you have legacy deals like RMBS, where the party that is responsible for the calculation is, a trustee or a calculation agent, and you have a portfolio of hundreds, if not thousands of deals that have the same issue, and that party now have a target on their back, the number is very large for them. And at that point, at least that party will want to bring and get resolution and protection that they're not going to get sued because somebody thinks that, however they've done it, follow the language of the contract to the letter, or actually observed what's happening in the market and take in account of what were the expectations. But that being said, we have seen parties collecting specific tranches. And sometimes, smart people figure out ways that others don't have yet seen, and so the market price might be very favorable to collect securities, at which point, again, a proceeding that you would think that for one investor or in one deal doesn't matter that much. When you aggregate it, it's real money.
And yeah, I'd also add, probably first of all, this is more of a zero-sum issue than like reps and warranties was the value was lost. And even on a sort of gross basis, probably the numbers aren't as big. But on the other hand, rep and warranty litigation is really expensive and uncertain. This is more, and maybe I'm underestimating how drawn out it would be, but this is more like I found the clause in the contract, and I'm going to go to a lawyer and get a memo that says this is how we think this clause could be interpreted, and you go to court, and that doesn't mean you have to go back and get 10 years of loan files and hire expert witnesses and all this stuff. Like, so even if the market-wide opportunity is not as big, it might be less of a risky endeavor as compared to putting together 25% of an RMBS deal and directing the trustee, and you run the risk of paying all of the litigation costs, and you only get a quarter of the benefit. I think it's a different cost-benefit calculus.
Thought to whether there would be shareholder litigations over the decision about what to do here. Chris had mentioned securities cases based on, reliance on there's potential for mischief there. If the if you're talking about the shareholders of the institution making the decision, I see that as unlikely. There's no misrepresentation type claim that is obvious to me. I'm going to want Chris and Sagi to weigh in as well. If it's a shareholder derivative action based on decisions that constitute breaches of fiduciary duty, I don't really see that either. I mean, from the perspective of the party making the decision, especially if it's the calculation agent or the trustee, there's usually a good faith standard in the contracts, right? And so whatever the decision is, and as I said before, that decision may be put to a court early for judicial blessing. But whatever that decision is, it just has to be made in good faith. So it can't be arbitrary. It's got to be based on a good faith reading of the contract. That could be where an opinion of counsel comes in. I don't know, as Stu said earlier, whether we're going to necessarily get opinions of counsel on these issues, but on the contract interpretation question, we might. If there's a good faith determination based on how we're seeing ISDA and SFIG and others weighing in on this issue, I think that's going to protect the party making the decision. I think it's important to memorialize the decision and how the decision is made and what the decision is based on. I think that can provide protection and fodder for a good faith defense. You guys have anything you want to add there?
The only thing I'll add is that if you're going more to whether there's a difference in risk even from your own shareholders between kind of a wait and see approach as opposed to be more proactive in terms of mapping the risk and making kind of informed decisions as to your actions, then in that regard, maybe there is something there that, mapping your risks, understanding really what are the risks for the particular role you're playing in those transactions, and then making informed decisions or next steps. I mean, those can probably be very beneficial even within your holders, because I can see the holders saying that, this was not a surprise, and look at the loss that just hit you because, you've done nothing.
You being who?
No, I mean, yeah, it would be, if it's a claim against the officers and directors, it's a high standard, right? But I think I could imagine fiduciary duty claims or disclosure. You failed to disclose that you were subject to this exposure.
And that goes back to the point also about notice. I think transparency about what you plan to do with respect to these issues is key. That won't necessarily shield you from liability as an issuer or a calculation agent or a sponsor, or an investor. But these are the suggestions that we have to mitigate risk to some extent. All right, I see that time is up. We are. What's that? Oh, is there another question? Oh, sorry. So I think if you're the party initiating the trust instruction proceeding, I talked about that bucketing project. That's in part why there's a lot of reasons to do that, but one reason is that if you're actually going into court, you could go in with all the deals that have similar language. It becomes a much bigger proceeding if you're giving notice to all of the affected parties in those deals. So that's one option. You could have separate proceedings that involves each of those different categories of deals. Now, you could also, and this I think would be a perfectly reasonable decision, you could go in with one deal and you could get a ruling and it'll apply to that deal, right? The order will apply specifically to that one deal. But then if there's litigation over deal 2, 3, and 4, you could point to a decision. Now the investor or whoever it is might be filing the lawsuit, say they didn't have an opportunity to be heard, and they will have their day in court. It's not going to be dispositive necessarily, but it's certainly going to be persuasive, especially if it's in the same court.
Yeah, if I'm an investor, I would be concerned about how those proceedings get structured, because the result in a particular case often depends on who shows up. And all the people who showed up here were the senior holders, and they all consented to a judgment. Now, that a consented judgment is probably not very good precedent, but the people who were really motivated to litigate were all on one side, and so we get a judgment, and that happens in the first 4 cases. And then there's another case that affects me, and I show up. There's a it's not res judicata on me, but it's precedent that the court is going to look to.
Okay, well, thank you to everyone for, yes, Stu, did you? Yeah, no, thanks to everyone for coming today. I hope this was informative and productive. We have cocktails and some food set up right down the hall in our reception area, and we hope you'll join us. We'll be there to answer any other questions that you have or just schmooze a little bit. Thank you.